Hey everyone, I am so excited to be back with another dividend stock investing video. I'm going to cover a topic today that I've been receiving a lot of questions about, and that is high yielders. I'm going to cover some stocks, some ETFs, and also some alternative investments in the video today that offer dividend yields as low as 5% and as high as 12%. And so these types of strategies, these types of investments, they can make a lot of sense for investors who are ready to experience financial freedom. That type of investor already has some money, wants to get the most possible yield out of that money. But these types of investments, they can also make sense in portfolios for investors that are not quite there yet, or even investors that are just starting out, but they want to experience the miracle of cash flow. They want to experience that cash flow coming in, because it's very motivating. It can be a very motivating strategy. And so I have a really exciting dividend video today. Before we even get started, please go ahead and smash that like button. If you love dividends as much as I do, please go ahead and subscribe as well, because I have so much amazing content on the way. And let's get started, everyone, with today's dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I want to start today with an ETF. It's called QYLD. So check it out on the screen right now. I am covering this one first because this is a popular request from the community, and everyone's been asking me about this ETF. This is an ETF that has net asset value, as you can see, of $2.8 billion. The price per share is $21.80, and they have a distribution yield right now of about 12%. If I take all of the distributions from the last 12 payments, they pay monthly, which is really helpful for someone that wants to live off of the distributions, wants to enjoy that income, wants to use that income to pay bills. This is a ETF that can really be helpful for those types of investors because it pays monthly. But when I add up the last 12 monthly payments, I divide by the current share price, I get a distribution yield of about 12%. And so this is a fund that is provided by the fund family called Global X. It's the Global X NASDAQ 100 covered call ETF, and they have an expense ratio of 0.6%. So that's what they take out of the performance out of the fund to pay for expenses. And so one of the things that I would like to start with today on this fund is just how does it work? At a high level, what is this all about? And so basically, this is a fund that writes calls. It writes covered calls on the NASDAQ 100. And so my understanding is what they do is they actually buy the individual stocks that comprise the NASDAQ 100. What they then do is at the beginning of each month, they write a covered call against it. It's covered because they own the underlying equities, and they're basically giving someone out there the right to purchase their equities at a given strike price. And when they write the covered call, they receive a premium up front. They receive cash. Now, the way in which they write their covered calls, these calls can't be called early. I think they have to wait the entire month till the end of the month where it could be called. And so during the course of that month, they have that premium money that they've already been paid, and my understanding is they use that money, sometimes at least, to invest. They can even invest it in companies or the entire index NASDAQ 100. When the end of the month comes around, basically what's going to happen is if the market went down, they're basically going to just not have to do anything. That covered call is probably going to expire worthless. The stock isn't going to get called away, nothing like that. Now, if the stock market went up, what's going to happen basically is the covered call is likely going to get called, but my understanding is they settle it in cash. And so the underlying stocks aren't actually getting called away, but they can use the premium and also the fact that they invested the premium during the month. That's what's going to get called away. They can call it away in cash. And then if the stock market goes sideways, we don't really know what's going to happen. Sometimes it could get called, sometimes it might not get called. It just depends on what goes down. But basically, the way that they have orchestrated everything here, I explained it very simply, is they do a covered call strategy on the NASDAQ 100, and that strategy allows them to generate a distribution yield of about 12% on an ongoing basis. But as you can see on the screen right now, I have two charts at the bottom of the screen, and the chart on the left shows the performance of the on a price per share or price per unit basis over the last 5 years. And it's basically gone nowhere. Yes, it's had ups and downs. And so certainly this is the type of investment that does carry volatility. But if you look at it over long periods of time, such as 5 years, it basically trades sideways. And so what I'm trying to say is there's really no upside optionality here. There's really no upside trajectory. The reason someone would invest in this is purely for the distribution yield, and it's higher because the NASDAQ carries more volatility. These are tech-centric companies. These are companies that can have more volatility. Now, also, as you can see on the bottom of the screen on the right, over the long term, since 2013, when the fund was started, the long-term trend is actually down. That's why that chart is red. And so it's actually gone down over the long haul in share price. And so that's actually, if there's one red flag from QYLD for me, that's the red flag right there, is that over long periods of time, is shareholder value actually getting eroded? And so is it a true 12% distribution yield, or is part of that 12% compensating for the fact that over very long periods of time, the share price, it's actually going down? And so that's something for investors to keep in mind. And quite frankly, for me at least, that's a deal breaker on this particular investment. Now, I have one that I'm going to speak about next, which is not a deal breaker for me. It's actually a sister ETF of this one on the S&P 500 that I like a bit better because it just carries less risk for my personal profile. But I know a lot of dividend investors in the community who are really hungry for cash flow. They really like QYLD because it does have more volatility in the NASDAQ, which allows them to generate a higher level of passive income, a higher distribution yield. And now I want to go through the taxes of all of this. So check it out on the screen right now. So what I did is I went to the Global X website and I started digging around and just trying to understand, hey, how do the taxes work for this thing? And so I was able to find some information from 2019 tax year. And basically what they were saying is 85% of this is taxed as short-term capital gains, and a 3% long-term capital gains, 12% return of capital. And so one of the other, I would say, downsides of something like this is that for investors that do get into it, it has some more complex taxes, similar to like an MLP or a real estate investment trust. It just has a little more complexity to it, in the sense that there's three components of it. And on the return of capital component, it's important to understand cost basis. And so when they return capital, the investor needs to track their cost basis, because if the investor ever sells, that reduced cost basis is what's going to have to be used in the capital gains calculation for actually selling the underlying asset. And so that creates a little more complexity for someone investing in something like this. Now, obviously, if this ETF was held in a retirement account or a tax advantage account, that could be a different scenario where something like this may make a little more sense. That being said, if it's in a retirement account, that's usually for someone who's in a situation where they can't tap into that to live off of the dividends. And so then again, you start questioning it from that perspective as well. But let's keep going. Check it out on the screen right now. And so there's pros and cons with something like this. I would say that the pros are, man, there's some immediate income here in 12% range. That is not bad. And quite frankly, over the last 5 years, the stock has been flat, or the ETF has been flat. And so hopefully some of that long-term downtrend is a thing of the past, and that they really are preserving the underlying capital in addition to offering that 12% yield, and the underlying capital isn't getting depleted. Now, in terms of cons, I would say the yield on cost is probably capped at the existing range. Are you going to get a better yield on cost a few years down the road than 12%? No, it's always going to be 12%. Taxes are a little bit more complex. And again, the con would be long-term share price is down. And so that being said, I'm going to tell you, there's another product from Global X that I like a little bit better for my personal situation. Yes, it offers a lower distribution yield, but the underlying asset has been a little bit more stable, or a lot more stable over the long run. That being said, it doesn't get as much interest. Check it out on the screen right now. I hear everyone talk about QYLD, but what about this one? XYLD, the ETF from Global X that does covered calls on the S&P 500. And so instead of doing the NASDAQ 100, this does the S&P 500. It's trading at 47.75. It has a distribution yield of 9%, so not as good as 12, but still pretty darn high. And it still offers monthly distributions. And the 9.2% is based on trailing 12 months monthly distributions. Now, what's so interesting is the net assets on this one are only 218 million. But net assets, if you remember on QYLD, are 2.5 billion. So most investors have gone for QYLD. I always do things a little bit differently. I guess that's just how I approach investing, how I approach life. I'm always doing things a little bit differently. And so for me, at least, I like the XYLD better. And so check it out on the screen right now. Yeah, it offers a lower distribution yield, but if you look at the underlying net asset value for the actual units in this ETF over the last 5 years and over the last over the long run since 2013, this one has been really stable, and that's why both charts are green. And so the underlying value is not getting eroded. It really is holding underlying value by paying 9%. And so it gets me thinking, hey, on the NASDAQ one, is it really 12% or is it more 9% if you account for underlying value getting eroded over the long run? I like this one a little bit better for that reason. Now, what I would say, and as you can see on the screen there, it pays these distributions monthly, which is awesome. I could not find the tax info on this one. They just showed the QYLD taxes when I was on the website for the Global X XYLD, but I'm assuming it's pretty similar. You got some short-term cap gains, long-term, and return of capital. Keep in mind that short-term is taxed in the United States at a higher rate than long-term. Return of capital is pretty cool, but it does create some accounting work. The strategy with this, quite frankly, is very similar to QYLD, except it substitutes the NASDAQ 100 with the S&P 500, less volatility, less yield, better underlying equity value. Now, there's another one called RYLD, which is a Russell 2000 small cap index covered call ETF, and I've heard of some investors in the dividend community go for the RYLD. I did not cover that here because for myself personally speaking, if I want to go for a covered call ETF, I'm just not... For me personally, I'm not as drawn to the Russell 2000 small company index. I would rather go for NASDAQ or S&P, and I'd probably go for this one in the S&P. I would say the pros here with XYLD is immediate income, which is obvious, and reasonably stable share price, which is important because I don't want to invest in a vehicle that erodes in value. Now, the cons are yield on cost. Again, it's capped. It's probably not going to go much higher than 9, and there's complex taxes. Now, one thing that I would say that's so exciting, as you can see on these charts, is from time to time, this ETF does take a dip, and one thing that investors might want to do is they might just want to try to time it. If an investor wanted immediate cash flow and was thinking like QYLD or XYLD or even RYLD, it might make sense just to hold on to the cash, wait for a dip, because whatever yield is getting locked in, that's going to be the yield. I don't think the yield is really going to go up over time. There's not really a concept of yield on cost growing over time with something like this. And so it probably makes sense for the investor to wait for the perfect entry point. Now, for me personally, will I be buying either of these the ETFs or the RYLD, any of those? Probably not. That being said, if I had to buy one, I'd buy the XYLD. And so that being said, I'm just not in a situation right now where I want a lot of ordinary income coming in above and beyond what I'm already doing, because I already have a lot I'm doing in that space, especially with some crypto assets that I'll briefly talk about at the end of the video today. And so I don't want too much overlap. I would say in my portfolio, I've kind of got that exposure already, so that's why I wouldn't do this. I would say another benefit of these, though, what's so cool about these is the investor doesn't have to go out and open up like another account to buy it. These could be purchased through like a traditional stockbroker account. And so I thought that was a really good thing about all this as well, because it's important to keep a financial life somewhat streamlined. You don't want all this unnecessary complexity, all these different accounts. And so it's really helpful that these could be purchased through a traditional broker account. Anyway, I want to switch gears here. I want to go from these ETFs. You've got my thoughts on those now. I want to go into some stocks. And in particular, one stock, just one came to mind for this video. Because again, I was thinking through the lens more of kind of using stocks or using investments, but getting kind of like a bond-like proxy, if you will. These are investments that give maximum cash flow right now. And so there was one stock that came to mind, and surprisingly enough, it was a sin stock. It was Universal Corporation. Check it out on the screen right now. Universal Corporation is a farming company. They farm the leaf used in sin stocks, and it's currently trading at $59.60. It pays a quarterly dividend of 77 cents, dividends per year 308. And so basically the starting dividend yield is 5.2%. Now keep in mind though, that is a qualified dividend, which is taxed in the United States as long-term cap gains. And so comparing 5 to 9 from XYLD, it's not kind of as bad as it looks, just because these are in a better tax bracket than the short-term cap gains that are most of the income coming from XYLD. And this company is trading at a PE of 23, but quite frankly, I think that's misleading. I think that's not an adjusted trailing 12 months EPS. And I started digging into it, but honestly, their 10Qs are a little difficult to decipher. And so on May 26, just a few days from now, their 2021 fiscal earnings are coming out, and that's when I'll really understand what their PE is. But their PE, in my opinion, it's probably quite a bit lower than what is represented right here. And so one thing I want to mention with Universal that's a little bit different than XYLD and QYLD is there is an element of dividend growth. Typically, they grow the dividend by 4 cents per year or 1 penny per quarter. And so if hypothetically the investor bought here over a course of 5 years, the dividends per year would grow by 20 cents because that 4 cents times 5 is 20 cents. And so the dividends per year after 5 years have passed wouldn't be 308 anymore. It would be 328. And so that dividend yield after just 5 years would get even better at 5.5%. And that doesn't even count reinvested dividends. That's assuming the investor is living off of these dividends. And so there is that element here. This is a bond-like instrument, but there is some element of dividend growth still, which I think is so important. And so one thing I want to show with this company is just look at the stock charts. Last 5 years, it's pretty similar to QYLD and XYLD. It's flat. Hasn't really gone anywhere. But when you look at all time, and keep in mind all time for this goes all the way back, like to 1984, but still, you can see a trend there, and yes, it's flattening out a bit, but I still am a believer that with Universal Corporation, there is an opportunity for some, not for a lot, but for some long-term capital appreciation. And so for an investor who that matters to, the investor's really in that mindset of cash flow, need it now to pay bills. But if the investor is willing to take a little bit less of a dividend yield and gets it in a qualified manner and wants a little bit of upside over the long run on share price, I think this is a really interesting stock to look at. And one thing I also want to show, as you can see on the screen right now, is a balance sheet analysis. This company, in my opinion, has a really fabulous balance sheet, and it's trading just over book value. What you see is they have total assets of $2.388 billion. They have total liabilities of $1.07 billion. And so their book value, or assets minus liabilities, is $1.317 billion. Now the market capitalization of this company right now is $1.4 billion. And so it's trading just at 108%, or basically 8% over their book value. And so it's trading right up. If this company just went out of business, it's trading just over book value. And so I kind of look at this as a reasonable buy here. I look at it as a bond-like stock. When I looked at Universal again today, it made me want to buy more, and maybe I will buy more in the coming weeks. And I did buy some more not so long ago, just a month or two ago, a few months ago. And so I'd say the pros with this is it's a bond-like investment with some stock upside. I would say there's dividend growth and a really sweet price to book. And quite frankly, I don't have to worry about covered calls. I don't have to worry about all that fancy stuff that's going on at QYLD or XYLD. This is just a company that does farming. And so on the cons, though, I would say there's some risk in their line of business. And there's a lot of negative sentiment against sin stocks. And I would also say, the 5% range dividend yield, it's not quite high enough for some people. It's not quite high enough, maybe even to be in this video, because some people looking to live off of cash flow right away, it ain't going to cut it at 5%. That being said, what I would say as you go through the video today, by the way, if you enjoy the video today, please smash that like button. It really means the world to me. A lot of prep work goes into these videos, and the more you smash the like button, the more people see it on YouTube. It helps me grow the community. And if you subscribe as well, you won't miss any of my upcoming videos. But what I was saying is, as you go through the video today, please make sure to consider, hey, anyone constructing a high yield portfolio, it doesn't have to be one thing or the other. It could be a blend. And so it could be a blend of QYLD, XYLD, Universal, and the investments that I'm going to speak about in a few minutes. But before I get there, check it out on the screen right now. I want to just quickly show that Universal, they have some news. They're exploring growth opportunities in adjacent industries. And so 10 to 20% of their earnings in 5 years' time will be coming from these adjacent industries. And these adjacent industries are largely in vegetables and fruit processing. And so I thought that's really cool. They're hedging, if you will, against their core business, which I think is really good, being that their core business is in farming, leaf use, and sin stocks. I also want to quickly go through just some balance sheet stuff because honestly, Universal Company has one of the best balance sheets I know of. And one of the things that compels me to continue to hold and add more to this stock as a long-term investor is their balance sheet. So check it out on the screen right now. This is the assets. And what you see on the assets is they have a lot of cash, 95 million. They have a good amount of accounts receivable and advances to suppliers. They have a good amount of inventories as well. And so current assets, $1.6 billion. But what I also really love about this balance sheet is the property, plant, and equipment. They own land. I love that. They own buildings, which I'm sure are quite valuable. And they have machinery and equipment. But what's so interesting is then they have less accumulated depreciation. And so my thought is the machinery, equipment, land, and buildings, is that real depreciation or is that phantom income? I would say some of that accumulated depreciation, potentially. It's not as much as it looks. And so what I'm saying is the assets might even be understated here. I don't know how they're carrying their land, buildings, machinery, and equipment. They may be carrying it lower than its value, and that accumulated depreciation really takes it down a notch even more. And so what I'm saying is overall, their total assets at the bottom, $2.388 billion, it may be even higher than that. This is a really clean balance sheet, and I want to show you the liabilities really quickly. Check it out right now. What you see in the liabilities is it's also pretty darn clean. They have total current liabilities of $346 million, long-term debt $518 million, so it's a good chunk of long-term debt. But overall, when I look at this balance sheet, both assets and liabilities, it's pretty darn clean. And I don't think, for example, that they are taking too much risk on long-term debt. And I don't think, for example, especially at the low interest rate environment, I don't think they're also doing anything wacky on assets and inflating it with like a ton of goodwill, for example, with all kinds of acquisitions. They have a clean balance sheet. All right, everyone. So with that, I want to go through a few more high yield investments. Check it out on the screen right now. We're still talking about stocks. So I want to go through a few more stocks. And so as you can see on the screen right now, there are some other possible substitutes for Universal. These ones, honestly, I don't like as much as Universal for this particular topic, but they're all great stocks that offer high yields. I've got Altria, Philip Morris, and AbbVie. Altria has the highest dividend yield of the bunch at 6.96% and a PE ratio forward 2021 of 10.75. So that's not bad. Philip Morris, which is a safer business because they're pure international, has a dividend yield just under 5%, forward PE of almost 16. And AbbVie has a dividend yield of 4.49% and a forward PE of 9. And so what I would say is all three of these could be suitable alternatives for Universal. They're not bond-like, but what's so great about these is these ones, more so than Universal, will offer some upside in terms of long-term dividend yield on cost, more so even than Universal, and these three offer upside equity appreciation. I would say probably more so than Universal, especially AbbVie. I think AbbVie, especially over long periods of time, could have more upside. Now, what I also have is a note here, and this note is be careful of yield traps. I would say lately, there's been companies cutting the dividend. Some of them are doing it just because, hey, things are really bad. The business has changed. Oil is a perfect example. Big oil got hit hard by the pandemic. Dividends got cut. You got to be careful about those types of industries when you're literally at retirement age, or you know, maybe you're younger but you're living a partial retirement, partial financial freedom. You don't want your dividend income to dry up. I own oil stocks, but I'm also really diversified, and I'm still working, and so it's a small part of what I do. But that being said, that's one possible segment or sector that contains risk. What I would also say, though, is there's another type of yield trap, and that's those companies like Danone that are just cutting the dividend kind of because they're getting pulled in with social pressures, if you will. I own Danone, by the way. There's also, though, companies that kind of fall into both buckets, like AT&T now says they're going to cut their dividend. This is a stock I've avoided over the years. I've largely avoided it just because I don't like their business model. I don't like their debt. And honestly, I just don't have a lot of passion for what they do. But now they're going to be cutting the dividend. And so it's honestly impossible to avoid all yield traps. And sometimes it's not even a yield trap. Like you could say, are the oil stocks, is it really a yield trap? I don't know, because at the time they could sustain the dividends, but then the pandemic hit and everything changed. The way I deal with all of this, honestly, is broad diversification across many different stocks, many different assets, and having a well-diversified portfolio just in case disaster does strike anywhere. But by the way, I've got much sensitivity for all the AT&T investors out there. I wish you all the greatest, nothing but success in that endeavor. And so what I want to do next is I want to also offer up one more possible alternative, and I have spoken about this at great length on my brand new crypto channel, which I'll link to in the pinned comment and the description below. So I don't want to repeat myself too much, because all of the investments so far today, they can be purchased in a traditional stock brokerage account. But the two investments I'm going to speak about next, they're a little different. They require an account with a crypto exchange such as BlockFi or Voyager. And anyway, check it out on the screen right now. And so what I want to just briefly mention is there are stablecoins out there, and one of them is US dollar coin, one is the Gemini US dollar coin. A stablecoin is basically a crypto asset that is pegged 1-to-1 with the US dollar. And these two crypto assets happen to have physical, real, audited dollar reserves to back them up. And so by investing commission-free with US dollar coin on Voyager, the investor can earn 9% annual percentage yield, and that's paid out monthly. If the investor invests in Gemini US dollar coin on BlockFi, that investor can earn 8.6% annual percentage yield. That is paid out monthly. And so the monthly amount is the 9% divided by 12, or the 8.6% divided by 12. Now, on Voyager, you could actually get even more than 9% if you're in the Voyager loyalty program, which I'm in. But anyways, I will link actually in the pinned comment below to my personal affiliate referral URLs for both Voyager and BlockFi. If you sign up for those, BlockFi, you can earn up to $250 in free Bitcoin. Voyager, you can earn up to $25 free Bitcoin. And if you deposit $100 or more and trade it into crypto assets. I'm compensated as well for both of those. Voyager, I get the $25 free Bitcoin too. BlockFi, I get compensated with affiliate referral commissions. And so check it out if you're not on either of those yet. They're really great programs. I cover them at great length on my crypto channel. But what I would say about both of those, I don't think those yields will always be this high. I expect them to go down over time as the industry matures. And right now what's happening is because there's so much volatility in the crypto market, there's a lot of traders out there that need to loan and borrow and trade cryptocurrencies. And so what BlockFi and Voyager do is they take these assets and they lend them out, but they lend them out in an over-collateralized manner. So if the person borrowing them runs into any issues, the collateral gets called and liquidated immediately. And so from that standpoint, I feel pretty good about them getting lent out because the technology is there to close out the over-collateralized loans instantly, to my understanding at least. But again, I would say they're really similar to XYLD and QYLD in terms of what they do overall. I mean, they do it in a very different manner, but this is exactly why I'm not in XYLD or QYLD, is because I've got USDC and GUSD. But again, a lot more about that on my crypto channel. All right, everyone. I hope you enjoyed the video today. If you enjoyed the video, please don't forget to smash the like button. It really means the world to me. Please don't forget to subscribe as well. And for those of you that don't know already, I also have a Patreon. And if you're at the Thug Life Investor level on Patreon, the $10 level, I'm uploading all of my analysis there. So all of the analysis in the video today, that will get uploaded to all my Thug Life supporters on Patreon. Also on Patreon, I have a homie level, $3 only per month. You can cancel it anytime. Try it out. If you don't like it, just cancel it. Most people on there seem to really love it. I'm uploading videos on there all the time, bonus videos. I think I have like 31 of them now. And I just uploaded a 2,500 word blog post on there today, just on my thoughts about volatility and how I deal with volatility in the stock market and beyond, in crypto too. And there's a lot of lessons that I've learned in there just about being an investor. All right, everyone, I really hope you enjoyed the video today. In terms of full disclosure, I own the assets, or many of the assets mentioned today. I am long Universal Corporation, ticker UVV. I am long Altria, ticker MO. I am long Philip Morris, ticker PM, and I am long AbbVie, ticker symbol ABBV. I own those stocks. Oh, and Danone, ticker DANOY. I own that stock too. I own all of those in my personal Dividend stock portfolio. Also, I own the crypto assets mentioned today. I'm long Voyager token, ticker VGX, US dollar coin, USDC, and Gemini coin, GUSD. Also, in terms of full disclosure, I am an affiliate of BlockFi and Voyager. I really love both of those platforms. Last, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. It's possible to lose a lot of money in the stock market. All right, everyone. Thank you so much for watching the video today. I'll see you in the comments below, and I'll see you in the next dividend investing video.